So every month when your money goes out for a mortgage payment, you might be saying, what the hell is all of my money going towards? Today, we're going to answer that question. And we're going to do it with a Michael Jackson song. I want to love you, P-Y-T, pretty young thing. In mortgages, it's not P-Y-T, it's P-I-T-I. What does P-I-T-I stand for? P stands for principal. That's principal, meaning the principal balance on your mortgage. I think we have all gotten into enough loan payments by now where we know that at the beginning of a loan payment, you're not paying anything toward that principal and you're paying all interest. Why? Because life sucks and then you die. So principal really is not that important, but it is eventually what we're trying to pay down. Sorry, that's the truth, right? I mean, principal is the most important, but at the same time, it's like, bitch, we ain't got time for principal. We got the letter I, which is for interest. The first I in P-I-T-I stands for interest. That is honestly what you're paying most of. Interest is important. Why? Because you want a really, really good interest rate, so therefore you pay less of it. It's the biggest portion of your mortgage payment when you first get started. The ways that you can control your interest payment on a mortgage is to just make your credit better, right? A lot of people will say, oh yeah, I'll give you a loan with a 580 credit score. The real truth is that you do not want that 580 credit score loan. The interest alone will make you cry every single day. To be in the ideal range, you really want to be a 620 to 640 and above. That's going to give you something that is much more manageable and something you're probably going to like a lot better. The T in P-I-T-I stands for taxes, okay? So when you look up a house and you see it on the internet and they tell you what the property taxes are and you're like, I don't care. Yeah, you do, because if your budget is $250,000 and the property taxes on the house that you're looking at is $1,500, and then you look at another house that is inside the city limits and the property taxes are $3,000, but the price is still $250,000, guess what? You can't afford the one with the more expensive property taxes. It doesn't matter what the price is because the taxes are too high. Some people get super, super frustrated because they don't look at the property taxes. That is definitely an integral part of your mortgage payment. The last I in P-I-T-I stands for insurance. You have to have homeowners insurance when you buy a house. They will not let you buy a house and not have homeowners insurance. Why? Because that would be stupid. That is not a good investment for the mortgage company. They're not going to give you the money to buy a house if it doesn't have some sort of insurance. And it's really good for you because, like, you know, what if it burns down? You need that insurance to protect yourself. When we get to a certain point in the lending process, they're going to ask you to pick a homeowner's insurance company. A lot of people, I always go with who I have all of my auto and all of my other insurance bundled with. Why? Because I love the customer service. But if you're really straddling the line on whether or not you're able to afford that house or not afford that house, sometimes you just have to pick the cheapest option available. And there's nothing wrong with that. Keep it for a year and see if you still like it or see if you're really unhappy, and then later you can change it. That being said, let's define a vocabulary word that I see a lot that I think that most people don't actually know what it means. Our word of the day today is escrow. I hear the word escrow a lot on HGTV. And let's be honest, that's where a lot of people get their first impressions on home buying. And I'm going to be honest with you that when you see escrow on HGTV, they make it sound like this beautiful, magical land. And to be honest, escrow is only a beautiful, magical land if you live in a place like California. When we say in Maryland that a home is under contract, that's really beautiful. Why? Because it means that the buyer is pretty much theirs. And for the seller, it means that they're pretty much gone. In California, they use the term in escrow. That's really the only difference. The term escrow in Maryland is actually super boring. It's also an important part of what makes up your mortgage payment. Escrow just means that they're holding it to the side. So let me give you an example. You pay your property taxes 2 times a year. You pay them in January and you pay them in July, but you're not actually paying them. The mortgage company pays your property taxes. Every month you're setting aside, escrow means setting aside. You're setting aside a little bit so that when that bill comes due, the mortgage company writes a check for you that goes to pay off your property taxes. That way you don't actually have to do it. You still will receive a bill in the mail, but it'll say on the top, this is not a bill. It's just letting you know, hey, this is what your property taxes are, but your mortgage company takes care of it from that escrow account. Similarly, your homeowner's insurance is paid once a year. They pay that big chunk of money out of your escrow account. It's a way to soften the blow for you, but still make sure that these providers get their money when they need it. Another important factor in some loans is what's called PMI, MIP, mortgage insurance, whatever you want to call it. It is usually a part of your mortgage payment every month. What is PMI? What purpose does it serve? Once again, when the lender determines whether or not you're a good candidate for the loan, if you're putting down less than 20%, they're feeling a little antsy. They're feeling a little weird about it, and they want you to put in an extra amount of money. Why? Because if this home goes into foreclosure, they need a certain amount of money, a certain amount of insurance, aka assurance, that you're still going to be able to pay this loan. PMI is required anytime you put down less than 20% on a loan. So basically, unless you're doing a 20% conventional, you're going to have to pay PMI. A 10% conventional, a 5% conventional. An FHA loan pays for PMI over the course of the entire loan. So does a USDA loan. So if you're putting down less than 20%, they're feeling a little uneasy and they're asking you for a little bit of extra money to go toward the mortgage insurance. I encounter so many people all the time who are saying, okay, I'm just going to sit around and wait until I can save 20% because they think that that's exactly what you have to pay. Or they say, well, I don't want to pay PMI, so I'm going to wait until I can save up 20%. First of all, you're going to be waiting for the rest of your life. So like, have fun with that, TTYL. But in all honesty, I've sold over 100 houses, and I think I've probably had people put down 20% maybe 2 or 3 times. It's not something that happens that often. In fact, most people, even if they have the 20%, they see that their mortgage payment, the difference between a 15% and a 20% or a 10% and a 20%, it doesn't change their mortgage payment that much, and they'd rather keep that money in the bank. Shouty, what you drank? Most people realize that they'd rather pay a little bit extra per month and keep that money where it needs to be. Which leads us to our topic for next week, which is once you have your PITI, your monthly mortgage payment set up, what other expenses should you be anticipating? Always a good question. All right. See you next time.